Hello traders community. Last time we presented the order blocks and how to trade using them. Today we are going to discuss about the breakers. So what is a breaker and how to trade using it? If an order block is violated or broken, it is qualified as a breaker, meaning price will retest back that order block. Sometimes we call it a failed order block. So there is two types of breakers, the bullish breaker and the bearish one. So let's start with the bearish breaker. Bearish breaker is the last down close candle in a swing low prior to a higher high. It becomes valid once stops are taken above a previous high and breaks below the swing low that contains the breaker candle. Bulls are trapped here and institutions are mitigating longs. Let's see a figure of a bearish breaker. In this figure, we have this last down candle before this momentum bullish move making a higher high. This last up move was nothing but a stop hunt, liquidation of a buy-side liquidity. After that, the swing low has been broken, showing a bearish momentum. We wait for the price to return back to the breaker to set a short position. Let's move on now to a chart example to clear things for you. In this chart, we have a bearish breaker example. First, we have a bullish order block that took the buy-side liquidity resting above the previous swing high. Price dropped down, then broke the bullish order block. After that, price returned back to retest the bearish breaker and continued lower. Bearish breaker occurs also on high time frames. In this example, we are using a weekly Nasdaq chart. We can see clearly this last down close candle that leads to this break of the previous swing high. Market makers took the buy side liquidity and dropped price down to break the previous swing low as well. Once price retested this breaker, it dropped down. Let's move on now to the bullish breaker. So bullish breaker is the last up close candle in the most recent swing high prior to an old low being violated. The sellers that sold this low and later see this same swing high violated will look to mitigate the loss. When price returns back to the swing high, this is a bullish trade setup worth considering. Let's see a figure of a bearish breaker. In this figure, we have this last up close candle that leads to this bearish move making a lower low. This last down move was created on purpose by market makers to take sell-side liquidity. After the break of this swing high showing a bullish momentum, we wait for the price to return back to the breaker to put a long position. We'll see a chart example of a bullish breaker so that you understand better the concept. In this chart example, we are using 2 hours Nasdaq chart. We have a bearish order block that made this break of structure, took the sell side liquidity resting below this low, and then turning bullish. The price broke the previous order block, retested the breaker, and then went up. We move now to the 30-minute Nasdaq chart. We have this bearish order block that made the break of the previous swing low to grab sell-side liquidity. Price turned to bullish after that and broke the order block. We wait for the retest to happen before taking a long position. Now we'll see another type of order blocks. It's called the mitigation block. So a bearish mitigation block occurs when price failed to make higher high before breaking market structure or order block and retesting the order block level, creating a lower low. This is effective if it occurs after an extensive bullish move. So let's see a figure of a bearish mitigation block. Unlike the bearish breaker, when price managed to make a higher high before dropping down, in this figure of bearish mitigation, price failed to break the previous swing high and made this bearish break of structure. It came back to retest the bearish mitigation before continuing lower. So let's move on to the chart to see some examples of mitigation block. In this example, we are using the 5-minute Nasdaq chart. In this bullish trend, price made higher highs until reaching this last swing high. Price fell this time to make another higher high and dropped down. After that, price returned back to the bearish mitigation block before continuing lower. For the bullish mitigation block, it's formed when price fails to make a lower low before breaking market structure or an order block and retesting order block level, creating a higher high. This is effective if it occurs after an extensive bearish move. So let's see a figure of a bullish mitigation block. In this figure, price failed to break the previous swing low and made this bullish break of structure. It came back after that to retest the bullish mitigation block before continuing higher. Let's move on now to the chart to see examples and clear up things for you. In this example, we are using the 15-minute Nasdaq chart. Price was bearish, making each time lower lows until reaching this last swing low. Price fell this time to make another lower low and turned bullish. Price returned back to the bullish mitigation block before continuing higher.